Hey friends, welcome to another episode of Navigating the Markets with me, Markets and Mayhem. We're going to talk about what happened last week and how that's setting us up for the week ahead, which is full of event volatility catalysts, including earnings, PCE, and GDP. Now first, let's talk about the week that was. We had some of the leadership cracking under increasing pressure. Most especially noteworthy is NVIDIA down 13.59%, ASML down 10.64%, Taiwan Semi down 10.4%, Broadcom down 10.37%, and AMD down 10.19%. But look at ARM down 30.98% as well. The semiconductor space led the way down, particularly on Friday when a lot of these stocks saw increasing pressure. The narrative is changing a bit. ASML and Taiwan Semi are telling us that there's not quite as much demand as what people were anticipating. On March 31st on Twitter, I mentioned that NVIDIA's sales are likely to slow even this year, and especially in 2025 and beyond. This was met with a lot of skepticism, but the reality is when you saturate a market and you have a big backlog, and then folks start to realize there might be other options and alternatives out there, once that backlog starts to dry up, your growth rate may as well. When you're selling what costs $3,000 to make for over $30,000, as Jeff Bezos said, your margin's my opportunity. The rest of the semis do see it that way. They formed a consortium to create a competitor to CUDA and to try to sell their own versions of GPU accelerators, of which AMD, Intel, Qualcomm, Broadcom, and others have their own that are competing products, and in some cases are cheaper and faster. They just lack the software ecosystem. So now they're intending to fix that. Other leadership also cracked, including Meta, down 6.02%. Microsoft down 5.4%, Amazon down 6.18%, and laggards fell further. Tesla down 14.03% on the week as the situation at the company becomes increasingly troubled, and Apple down 6.54% on the week. But you'll notice, looking at this heat map, it's not all red. There were plenty of pockets of strength amid this declining market that was led lower by prior positive momentum leadership. That is to say, the 7 biggest stocks didn't do the market any favors last week, and that really helped to pull the indices lower, despite places like healthcare, utilities, financials, consumer defensives, telecoms, aerospace and defense, metals and mining, energy, everything kind of outside of big tech didn't have as bad of a week overall. And there were pockets of strength. These are part of themes that I've been talking about that we'll continue to talk about as long as they work. But before we get into where I continue to think there are opportunities in the market, let's talk about some of the other areas, including sentiment. AA retail sentiment declined meaningfully last week to 1.13. That's telling you bulls are still in excess of bears by about 13%. To me, I still think there's room for this measure to wash out a bit lower. And when we look at where the bottom was in sentiment in late October of 2023, which coincided with a market bottom, that was when we were at around 0.45. So I'm going to say that it's more likely that bears need to outnumber bulls, that there needs to be some degree of capitulation in sentiment before we find a more durable bottom. That doesn't mean we can't have pops, but I think it's also important to contextualize Friday to Monday sell-offs are quite common. That continuation over, the Friday close, the remaining pressure of selling coming into Monday, it's more likely that Tuesday you start to see a bid come back if those dynamics hold, which I think there's a reasonable likelihood that they could. We'll probably get a bid overnight in futures like we have, and then we could see a bit of a sell down going into next week. And remember, any kind of supportive flows from buybacks are on pause. Now you have those supportive put decay flows, the Vanna and Charm second order Greek flows on pause over the week ahead. And you have a lot of folks that are more likely to want to distribute than accumulate. And we'll talk about why I think that is and some of the signs we see under the surface. But next up, we have NAAIM. This is a survey of managed money. And we see institutional positioning fell further. There was more bearish hedging, right, as well. But overall, it was more distribution than hedging. And this measure, like sentiment, could have farther to fall. We can see that back in that late October bottom of positioning, which was close to a market bottom as well, this was closer to the mid 20s. We're right now in the low 60s. So I still think that if we're seeing a proper flush, this could have farther to go. We're not quite there yet. When we look at NASDAQ stocks above their 20-day moving average, 19.83% are there. That's not quite washed out, exhaustive selling territory. We did see a dip lower last week briefly. I think we're around 15%, but that reset because we had some days where there was a bit of a corrective intraday bounce, and also most of the distribution was happening from a concentrated set of stocks. So we haven't yet gotten to that exhaustion level here on a week over week basis. Just on an intraday and daily close basis, I would want to see it over a longer time frame, only to say that it makes it more likely you get a more sustainable bounce. So we have 3 charts in a row that are kind of telling us the same thing. Closer, but not quite there yet in terms of real exhaustion. But let's add to that, because I like to look at these different data sets and contextualize where we are. NAMO, the NASDAQ McClellan oscillator. Negative 47. I like to see it below negative 70. To show more exhaustion. Doesn't mean it has to be there, right? We can see in October, November, it actually bottomed a little bit higher than where we were now, right? So this isn't necessarily like a one data point that you look at and you can make your entire decision, but it's one data point to look at, because when you do see more exhaustive sell-offs, they lead to usually stronger bounces, and certainly ones that can be a bit more violent. So it's more of an indicator for shorts to look out. We don't see that kind of exhaustion yet. You can see that in the reaction to the Silicon Valley banking crisis in 2023. There was that dip below 70 to negative 81. You could also see during the 2022 sell down, September, we got to negative 94. That's more exhaustive. So we haven't seen one of those readings in this measure quite yet. And I would be looking for that if I'm going to say, the risk off moment is becoming outweighed by the risk on, upside right tail type of scenario playing out. In other words, I don't think there's enough measures to say we're oversold and due for an imminent strong bounce, especially after closing below that key level of options positioning at SPX 5000. That's where the largest amount of puts and calls on the index are. Closing below that last week was a bit of an issue, particularly on options expiration Friday, because now we're unclenched from all that gamma, with the path of least resistance being lower in negative gamma territory, with a lower liquidity environment that could induce higher levels of realized and potentially implied volatility. This is an environment to be a bit more careful about taking on too much risk, and also where you're taking positions of what size and where you're placing your stops. For me, I'm much more selective of trades in negative gamma and low liquidity environments, particularly when they're together, like they are right now, ahead of a week where there's so many event volatility catalysts that could cause the market to go up or down in a big way. Now, we do have a little bit of an improvement in the new highs versus new lows. Last week, the NASDAQ composite closed with 172 new lows in excess of new highs, but this still doesn't look great. It's telling me there's a breakdown underneath the surface of the index that started even before the index had its bigger selling pressure like we saw last week. This is important to me because it's showing me that there's a lot of stocks that are struggling again. Remember, this started to look a lot better in February and March of this year. Right? We started to get to levels of new highs outpacing new lows that we hadn't seen in a year or more. Now we're on the other side of that. Now we're on this a bit of a picture that tells us that there's actually a fair amount of distributive pressure underneath the surface that's causing some rolling over. And you'll recall on the Discord, I pointed out that the NASDAQ oscillator that I built for TraderAid is showing another sell signal. It was earlier in April I pointed this out. I said this is a swing sell signal based on momentum, And that has been a really reliable indicator. And this time it's working just the same as it has in the past. You don't want to fade this thing. It's a good place to, when the signal fires off, if you're long, it's a good place to trim or to hedge. If you're looking for opportunities for tactical shorts, it's a good place to look for longer duration tech and growth to roll over more. So that's exactly what this indicator said. And certainly the market is showing us that once again, it was correct, just like it can be correct on the rallies. Look at that buy signal that we saw in early November and how powerful that was up into the beginning of this year. Now, SKU fell last week. This is unusual. I know we had options expiration, so we had positioning roll off on Friday. Let's take that into account and also consider those hedges weren't rolled into future expirations. That's kind of interesting if you think about what's happening during the week ahead. You've got 40+% of the S&P companies reporting and you've also got this enormous amount of economic data with PCE and GDP. These tend to be prints that the market reacts to, especially the rates market, which has had an increasing effect on stocks lately. And then you also have this environment where, again, buybacks are on pause. We're in negative gamma, and we have rising geopolitical tensions in many parts of the world, not just the Middle East. This all kind of sets us up for an environment where I would think if I was a risk manager, I'd be telling the trading desks, guys, you really need to increase your hedging. Like, this is when we need to have higher levels of hedges. Instead, because the risk manager is always going to give you two options, it looks like the trading desk chose option B, lighten up on your longs, right? That's kind of interesting if you think about it. Instead of hedging into next week, they seem content to actually distribute long positioning. Otherwise, we should have seen this pick up into what promises to be a pretty intense week. We should watch SKU as we get closer to some of these key event volatility catalysts, because again, if it continues at these lower levels, this market being poorly hedged is more vulnerable. If you have people that are in positions that are poorly hedged, they can sell down their longs and reduce value at risk, but it still hurts when the market goes down. And that could cause their risk managers to tap them on the shoulder and say, once again, hedge or sell. The other element I've been watching is commodities starting to outperform the S&P. This reflation theme sets up some trade ideas that we've been talking about for several months, and they really are playing out. These trade ideas are also part of this theme, this handoff, right? We had last year a period of disinflation, of rates beginning to drop, of financial conditions easing, and that was really good for long duration risk. This year we have the opposite. And so we see these interest sensitive rates of the market, interest rate sensitive parts of the market falling out of favor. The Russell 2000, where about 40% of it doesn't make any money. And then there's the regionals, which are very sensitive to longer end rates given their exposure to duration. So over half the Russell, quite rate sensitive, it's falling. It's down 8.7% from recent highs. The Mag 7 group, also a long duration asset, a little less rate sensitive than it used to be, but still sensitive to rates when they appreciate to levels that they have, down 8.4% from its highs, and the NASDAQ down 7% from its highs. Earlier this year, I mentioned that 4.5% and in excess of that, especially on the 10-year note, would be somewhere a line in the sand that equities would start to pay attention and where rates would start to matter again for risk. And we've certainly seen that. And I stand by that view that 4.5% is a very important line in the sand. As we push above it, the dollar strengthens. 40% of S&P 500 companies make a lot of revenues from overseas, right? It's about 40% of S&P total revenue that's coming from overseas, right? So if you contextualize it from that view, when the dollar appreciates, that hurts that revenue stream. And as that revenue stream is contracting, they have to take these Forex headwinds as a risk. We also see the rising dollar putting emerging market debt under increasing pressure. That's a problem. That's a problem because that creates the sort of demand for dollars, which further appreciates the dollar as well. People try to pay down that debt before it gets more expensive to pay back, and you get these dollar shortages potentially. Now, we do have swap lines that are open, so the dollar's appreciation has been more orderly, but I don't think the dollar's rise is over. As long as there's a rising risk of inflation, as long as the Fed is jawboning hawkishly, and as long as there is a lack of demand for U.S. paper as a result of that, and these enormous deficits that are being run, the path of least resistance for rates is likely higher from here. Now, let's say in this environment that it's not all just bad news for stocks. It's only bad news for certain stocks. This is the most important part of understanding the environment we're in right now. It's that there's a rotation happening. And rotations mean that institutional money is going into other parts of the market, and those parts of the market are outperforming. The first is one of the areas we've been talking about for quite some time, really starting late last year. I got real excited about energy. I was very vocal about it on the Discord and navigating the markets and midweek updates. Look at XLE versus the SPY. This is huge. This outperformance really for the whole year shows you where smart money is coming into energy. Energy is outperforming the S&P. And I believe this trend has further to go, particularly in higher quality parts of the energy space. We've talked about Exxon, Chevron, Liberty Energy, Patterson. We've talked about Vital. There's a number of different plays in energy, Schlumberger, Halliburton, that still look good. Diamondback or Fang, Devon Energy. It's really time to look at the energy market as a stock picker's market, but it's not just energy. It's industrials too. This has been a theme that I started to talk about earlier this year, saying that reflation theme, commodities strengthening, rates rising, and this sort of late cycle environment of an overheating economy and lots of government stimulus heading into infrastructure and reshoring. That's great for industrials. And industrials have been outperforming the S&P pretty significantly. And that gives us a sense that, you know what? That is a rotation. It's one to lean into because there are strong names in that space that stand to benefit from this environment as well. So when we get these corrections in the market, when things are selling down and you see there's relative strength in these areas, it's telling you money is going out of Tesla and Nvidia and Microsoft and, and Broadcom and all these favorites, and it's going into these older economy names, a theme that we've been talking about for some time as something to watch out for. Now it's playing out. The next area is materials. Similar to industrials, it does well with these tailwinds, these macro tailwinds of reshoring, of government stimulus, and of demand starting to come back in other parts of the world. We can see manufacturing coming out of contraction. This is all good for materials. These are all macro-driven trades where momentum and macro are on the same page, and that can set up for fantastic swing opportunities. The next one is metals and mining. Metals and mining seeing incredible relative strength popping up from late March. We can see that in the rally in copper, breaking out of this long-term range. The PGM metals group, platinum and palladium starting to rise again. And we see, of course, gold and silver showing a lot of strength as well. So this has been an area where there's been pretty dramatic outperformance. I mean, from those March lows to the present, this thing's up about 10% versus the S&P in a pair trade. So, again, these rotations offer opportunity. They tell us where smart money is going. It behooves us as swing traders and investors to pay attention. The next one is utilities. And this is a flight to safety trade with a macro tailwind of increasing demand for energy. Energy utilization is set to double over the next 10 years based on projections from increased manufacturing, data centers, AI, crypto mining, you name it. There's all kinds of different tailwinds that are adding to power demand. And this is something that we have to take seriously because there's not enough power. So that means it's bullish for the energy space. It's bullish for the mining space. It's bullish for, because you got to have copper to build transmission capacity. And it's bullish for utilities because you're going to need to add to the volume of power. And that means they're going to have CapEx in the near term, but in the long term, they're going to have much larger revenue streams and potentially better bottom lines. The next one is, of course, aerospace and defense. This has been one I've been talking about for about 6 months, as an area to want to be bullish because there is such strong demand in a world of rising geopolitical risks. So I'm still bullish of it. I hate to be bullish of it because it means things are crazy in the world right now, but there's no getting away from the fact that the DoD budget's going to keep rising, that Europe and other allies are going to keep buying exports from U.S. arms makers and defense companies, and that in a world of rising risks, this sector tends to do well. And we also have commodities. We saw in the prior chart, commodities versus the S&P, but this is DBC versus SPY. This is another rotational relative strength area that shows you, again, there's opportunity even outside of U.S. stocks. Commodities have been a better trade than being long stocks in this market. And really, that's a trend that started in late March. Now, DBA is an even more concentrated bet on the softs and potentially the grains starting to pick up the slack here. I could see corn, wheat, and soy potentially starting to rise in concert with things like cocoa and other areas that have been leaders. I could see other parts of the agricultural space, even feeder cattle, lean hogs coming back as well. But this has been a massive outperformer. The relative strength has been huge, and I think it's set to continue because those rotational flows and those real supply crunches continue to drive this thing higher versus the broader market. Now, areas to watch for the beginning of the next rotations, value versus growth is one, right? This looks interesting. Let's see if it continues. It's a little early yet, but I like it. It makes a lot of sense that people want to run into companies with strong free cash flow and strong balance sheets and away from more speculative parts in the market and an environment of diminishing liquidity, rising rates, and a more cautious Fed with inflation potentially reaccelerating further. Another one to watch is equal weight versus SPY. I have 2/3 of my total position on in this one. I'm looking for this relative strength to continue and break out of the range, and then I'll add that last third on because I think this will be a longer term theme as a pair trade, long equal weight, short market cap weight, as a rotation away from the Mag 7 to the inglorious 493, as their earnings could start to appreciate at a faster rate, and yet they're objectively cheaper. Now, coming up to next week is going to be a real busy week. We've got durables on Wednesday, advanced GDP for Q1 on Thursday, and we've got PCE on Friday. So looking ahead to GDP, the Atlanta Fed GDP Now model is looking for 2.9%. It's been revised higher because of a slew of surprisingly strong economic data. And if this comes in too much higher than expectations, it could be a risk-off rates up event. Similar PCE. The expectations are pretty tame. That is to say, month over month, 0.32% on headline, 0.3% on core. Now, if you annualize that print in a nutshell, it would suggest that the rate is about 3.6% year over year, which is obviously higher than what the Fed wants. It shows some degree of reacceleration, but then the year over year prints are expected to be somewhat tame. Headline at 2.65%. And core at 2.74%. I think if they come in that low, the market may breathe a little sigh of relief, but if they come in materially higher, and especially with a 3 handle, I think we could see another rates up risk off event. So this is going to be one to watch closely. The macro data matters, rates matter, and the market reaction to that macro data and that rates is becoming more sensitive. We also have a big week of earnings ahead. Pick your sector: tech, telecom, energy, financials, software. Everything's got earnings next week. This is a huge amount. It's like 42% of S&P companies reporting next week. I believe that it's going to be one of the most important weeks of this year because it'll be defining in terms of whether the trends of recovery continue, if we see rotations in earnings growth away from the concentrated areas of the market that have been carrying things to some of the less appreciated areas of the market that are objectively cheaper, and that could provide some opportunities and continuations to the themes we've been talking about. So in summary, liquidity is low, volatility is back, markets are not yet exhausted to the downside, commodities are outperforming the S&P, and that sets up for some trades. It also causes rates to rise along with inflation reacceleration risks. The Fed signaling cuts may happen even later than the market thinks. Even some Fed speakers have hinted at hikes if appropriate. And rotations are continuing into energy, industrials, materials, metals and mining, defense, and utilities. And we're starting to look at value versus growth and equal weight versus the S&P again. So that's everything I've got. If you have any questions, leave them in the comments or ask me on Discord. As always, appreciate everyone's support for Trader Aid. You guys are awesome, and I'll catch up with you soon.